Okay, welcome to video number 3 on the TOS Analyze tab series. Again, these videos are progressive, so if you haven't watched video 1 or video 2, probably should go back so you can follow through the concepts we're going to end up looking at here in video 3. Today's focus will be the Thinkback tab, and we're going to look at the Thinkback tab the same way we did in video 2 in the risk profile. We looked at the long call, and we are going to do that on the Thinkback tab in a very similar way today. What Thinkback will give us the ability to do in addition is we can compare the P&L of a long call in a bull, a neutral, and a bear market simply by choosing a time frame in the past. That'll allow you to decide how things react, or understand how things react, and select the best calls, puts, deltas, etc. for your strategy. Okay, we'll switch over to Thinkorswim. This is the risk profile tab, and it's the long call we analyzed in video number 2. Just a short review. The risk profile tab is really designed for you to analyze a current trade and what it might do in a future situation based on price action. When you switch to the Thinkback tab, this tab is really designed to go back in time so you can apply trades in different market conditions and see what the actual P&L is going to do from real price action, and allow you to determine what you might do and how you might react when something goes against you, doesn't go quite as you think it should. So what we did in video 2 was we looked at 3 calls from the same option series, and we chose different deltas. Here we chose around a 90 delta, around a 70 delta, and around a 10 delta. We're going to do the same thing here with these 3 going back to July 2 of 2013, selecting the 139, 155, and 173 calls based on their delta values. And we will take it one step further, and we'll also add in the 165 call from a different date with less days from expiration, because the original series had 80 days. This series will have 60. And then we'll move forward in time again to 813 and select the Delta 70 call and show you how all of those compare based on time. So for this presentation, I've prepared a lot of details. This is tedious, it takes a lot of time, but this is something you don't want to do and you don't have to do each time. But going through this exercise once or twice will really allow you to get results quickly and understand what you're doing, when you're doing it, why you're doing it. So for each strategy you use, such as a call, a put, short credit spreads, etc., take the time to play out a strategy in a bull market, a neutral market, and a bear market, so you're fully prepared not only to take advantage of an opportunity when it presents itself, but also to prepare yourself for what to do when a market goes against you. So we're going to look at this series in a bull, neutral, and a bear market so you can see what the differences are. So switching back to Thinkorswim on the Thinkback tab, what we're going to do is, first thing you come in here, you always want to reset everything back to ground zero. So I'm going to click reset and say yes. And what that does is it changes the date back to the current date, and it deletes all Thinkback trades. Actually, I think it just hid them. It didn't actually delete them. So we're going to, I think we can do it this way, delete all back trades with this X. It has removed all back trades and reset the chart to ground zero. So first thing we're going to have to do is go in and add those series. And I'm going to just scrunch down the chart a little bit so that we can look at the option chains, the option chain in the various series a little bit easier. We're going to add those 3 calls but we have to start by setting this to the proper date so it brings in the proper data from history. So I said we're going to go back to July of 2013, July 2nd actually. So when I click on July 2nd, 2013, it actually loads up the option chain from that day. So we're going to look at the September series here, and notice it has 80 days to expiration, and I'll open that up, and notice the implied volatility by expiration date. So this will be by the September contract expiration. It has a volatility of 17.5% plus or minus, and that's an equal to $10.55 up or down by that time that contract expires. So let's add those three. I'm going to open this up so I can quickly add them. If you need a refresher on how to add them, please go back to the previous videos. Change this layout to the delta gamma theta vega so we can see those deltas that we're looking at. First call we want to add is the 139 call. You see if I click on that 139 call, here is our delta of 90. So I'm going to click on the left click on buy and they ask to buy that. It loads it up in the back trade. So that's one. We're going to also add the 155. And the 155 is actually a 68 delta. We're going for near 70. As we said in the previous video, roughly 70 is a pretty sweet spot for buying calls or puts. So I'll add that one. And we're going to slide down to the 173. And you see that's at 11, so it's very close to 10. So I've added those three. Now, as long as we're here, I'm going to add two more. Because it takes a little time to add these, and I'd just like to get it out of the way. So, but what we're going to do is we're going to add them from 2 points in the future. These were all based on the trade date of 7/2/13. If I want to get the trade data in there for a different date, I got to come up here and change this date. I'm going to change it to 7/22. Now it loads up that data, and we're going to go right back to that same series in September 13. Notice it's only 60 days now instead of the previous 80. And we're going to add the 165. And we're going to add the 165 because that's near 70. But this one, remember, it assumes we're purchasing it on 7/22. So I'm going to click on that and add that one. I'm going to add one more, but I'm going to change this date to August 13th. And we're going to go back to our September and look for the 166 call. It's at a 67 delta. I'm going to add that. So you can see that we've added these different puts, or excuse me, calls at these different dates. Here's your dates. So in order to start the process, we're going to switch back to our original date. So we're analyzing everything from the right time frame. 7/2. This date right here only affects your option chain up here. It does not affect anything down below. So in order to get that chart a little bit bigger, I'm going to squeeze this up a little bit and try to put our September 13 right there with 80 days and 10.55 up. Bring this chart up just a little bit. This doesn't work perfect. Alright. So I'm going to get all those on there. Okay. So now we've got all of these things exposed, and they all default to 10 contracts. To make life easier, we're going to switch these all to one contract. And you'll note that the checkbox next to each of these means it's analyzing all of these as one complete package right now, and we don't want to do that. We only want to analyze one at a time. So I'm going to uncheck all of the items we do not want to see. And in order to make this viewing a little bit easier for the video, and you can do this on your own, notice that the orange line is Thinkback P&L, and it does say that right up here in the chart, but it's a little hard to see. So I'm going to right click on that line, edit that, change it to purple, maybe make the line a little thicker just for make our viewing a little bit easier. I'm also going to add another line to help us view the P&L, because we have two vertical axes here. The vertical axis on the left is your P&L line. Notice it's got the purple number, and this purple line is your P&L for whatever option you have selected here. And of course the candles are the price chart with the right hand axis. And you know those are separate. They use the same controls as they do on every other Thinkorswim chart. You can have more or less resolution by simply dragging the scale up or down, and you can see that your purple line is changing, adding more or less. Double clicking resets it. Hold down the control key and the arrow, and you can simply move this up and down and separate it all you want. And of course you can do that with the price action as well. Depends on what you want to get a better view of, just like that. We are going to leave it at its default, which means both are centered on the screen. And what we're going to do to make viewing P&L just one step easier, we're going to add a horizontal price line based on the left hand axis as your P&L. I'm going to add this price line right here at 0. So now that price line is at approximately 0. It's not perfect, but realizing that if this is your P&L going up and down, here's where your break-even point is. So we want to make that nice and clear as we look at these things. And it looks like the reset of the P&L date did not happen when I reset the chart, so I'm going to reset this back to our original purchase date of 7/2. So this date selection right here controls the back trades. Any data you see in here is based on this date right here. So right now we have this call selected. It's the September 13. We purchased it on July 2nd for $22.85 with a excuse me. And the delta on the Thinkback tab here is shown in a per contract basis, not a per share basis, which it is shown up here in the option chain. So this is really a 90 delta, 68 delta, or 11 delta, and your theta decay. So now we have that particular option selected with the 90 delta. You came in at 7/2. This is our purchase date right here, and you can see right away that the spider started going up, and therefore your P&L. Notice your P&L scale is 0 to $100 at the moment. And as it goes up, notice as price action goes sideways, so does your profit. Goes absolute sideways. Always remember, long calls, you're losing time decay as this goes by. How do you know how much time decay you're losing each and every day? Well, if you look at the theta, it's minus 17, and this is in a per share. If you select this date scroll bar, arrows right here, you can step through day by day and notice your P&L prices will change in here. It takes a little bit of update time, but you can see what the value of things are in these particular dates as you scroll through. But the easiest way is to simply look at this chart, follow it through, understand you're losing time decay every day, and your delta is being adjusted based on the price movement as well. So you can sit here and look, watch my profit goes up even as the price goes sideways. I still, at this point, after it went sideways for nearly a month, I'm still at $76 profit, and I'm looking at the left-hand axis right over here. Wherever I move my cursor up and down, that's telling me what that particular profit is. You can also look right up here for a particular day. Notice, as soon as that stock starts to go down, in this case the spiders, the ETF goes down a little bit, you rapidly lose profit. And it does very closely follow the price action. Now it ended up over here, and the spiders closed at roughly 170 on this expiration day. Change the chart just a little bit so we can see the actual expiration. So there's the actual expiration day. So this is your last day to trade before contract expiration. Now take a quick look back up here on your September 13th when we had 80 days left. This said there was a 68% chance that the price of the spiders is going to be plus or minus $10 from the point it was on that day on 7/2. Well, on 7/2, it was right down here at $161. On 9/20 expiration, it was at $170. So it stayed within that range of plus or minus $10 that whole time. So these statistics can help you very much get a reasonably good estimate of what's possible. It's not perfect. Things happen, events happen, surprises, happen all the time. But based on history, that's a good statistic. So, excuse me. So what might you have done here as you've gone along? You might have used your technical analysis, and you may have come up here and felt it was going sideways. You could have sold, let's say you bought 10 contracts, you could have sold out half of them, banked some profit, and hung on to the rest if you wanted to. Or let's say you didn't. Let's say you waited back to here. Well, now might be the time to sell out because you don't know how far it's going to go down. Again, looking at these things from the point of view of history gives you the chance to think about how you would react if something goes against you and how much it's going to cost you. You don't have to risk real money to figure it out. You can come in here and plan for exactly how you're going to prepare and what you're going to do in case something happens. Now sure, this one was nice because ultimately if you just held on to it right till the end and you sold out in this day, you're going to come out with a nice profit. But remember, you paid $22,000 for that call, and it was just crazy amount of money for one contract. So we're going to switch to this next one, which is the approximately delta 70 contract, in this case delta 68. Notice that the P&L scale went from 0 to 100. Now it's about 0 to 80 is the main scale, and our zero line moves, so I'm going to move that down so we get a better view of where 0 is. And you'll notice the difference here is, hey, profit went up real nice, just not quite as much. But as it went down, we did get almost back down to break even, where in the more expensive, higher probability call, remember delta is also your probability, 90% probability of finishing in the money, in this case 68% probability of finishing in the money. It did start to come down to break even, but when the price went back up before expiration, you had your opportunity to sell out, add a nice profit, and it was, of course, within that statistic range of 68% or 1 standard deviation. Now we're going to switch to the 10 delta, and you'll notice this isn't as appealing, right? Had you bought this call and you sold out right about here or even here, life is very good, right? Should notice the scale. It actually starts out at a loss of -5 and it only goes up to 1250. So your profit potential is way down. And if you decided to hold that all the way through thinking you're going to get a big move, remember it only anticipated a $10.85 move at maximum. So you should only be planning your trades around what statistically is possible. But over here, time decay just ate away, and the price didn't move enough to bring it back. So you are all the way at a full loss by the time this ended up, if you sold out on this day. So just like in the previous video too, where we were talking about strictly what is the value of purchasing a call, not based on price, but based on value, meaning what are the odds of it finishing in your favor in your given time frame. In this case, it was about that 70 delta call. So we will. Now let's take a look at, remember we purchased this on 7.2. We're up here, and we're showing the P&L at 7.2 in this chart. We also added a couple other calls where we actually purchased it farther out in time. So here we went 10 days farther out. So I'm going to select that one. So instead of purchasing that one back at 7.2 over here, we'd purchased it on 7.22 here. So that is really only, what was that, 60 days. That's 60 days from the point we purchased it, and it's still a delta 70 call. And you notice how it reacted very similar to the previous one, previous delta 70. We never got below zero, but we purchased it immediately. The stock started going sideways instead of over here where we purchased it and the stock started going up immediately. I should be using the word underline. The underline started going up. Well, you don't always know. So in this case, you're losing time decay right here, and if you step through, you will see that happening each and every day. Or you can just follow off with your graph here, move your cursor, and you can see what your P&L is doing each and every day. So you can decide what you're going to do. Hey, this thing's going sideways for 3 days. My timing's wrong. Maybe I should get out. Maybe I should sell a put spread. Or, hey, as soon as you get a nice big down day, you notice, hey, I'm already getting a small loss. Maybe I should get out, wait for a better entry signal. Because had you done that and then jumped back in over here, notice you would have gained everything back. And so don't be afraid to get out. You can always get back in. Keep your losses small and be prepared to let your profits run, but don't just do it blindly. Use your technical analysis, know when to get out. So now we've purchased a call here when a bull market ensued. We've purchased a call here when it started out neutral. Now we're going to purchase a call when the bear market kicks in, right here at 8.13. So I'm going to turn that one on, turn this one off. Now look what happens immediately. That was a delta 70 call. Immediately you're losing money right off the bat. Notice we should adjust the zero line. Zero line is way up here. So the day you purchase it, or the day after you purchase it, it's immediately losing money. So right here you may have thought that was a signal to go long. Hey, you're wrong. What do? Do you sit through it? Do you wait for a bounce? You know, that decision is something you have to make based on your own analysis of the underlying and your technical analysis, the statistics on that particular day. Because, for example, if we were to change this to that date of 8/13, so now you can see that 8/13 day. From that point, the underlying has a plus or minus 472 potential statistically. That's one standard deviation. Well, from here, that day was 169.63, and where did it end up? It ended up at 170. So again, statistically, these numbers are pretty good, with the exception of events, you know, and unusual activity. So it's not 100%, but it gives you a starting basis with the point of probability. This allows you to select your options based on value, not cost. Because you may pay an awful lot for a very high probability, but your profit potential isn't that great. Here, you have a lower probability on your delta 70, but it's a much lower cost. So you have much more value in this if you manage the trade. If you come down to a simple delta 70 or delta 10, excuse me, there is very little value in purchasing something like this because you need the price action to go very much with you for a consistent period of time, and you need to be prepared to get out. That might be the right thing to do for your particular strategy, your particular day. But these tools here, risk profile, Thinkback, they allow you to figure it out in advance and prepare yourself. I hope that helps with the risk profile and Thinkback tab. Future videos will include different strategies, short put spreads, long call spreads, and combining these things. Have a great day.